Just a few years ago, car dealerships were untouchable. Demand was sky high, supply was scarce, and prices were out of control. But now, the tables have turned hard. Lots are overflowing with unsold cars, prices are plummeting, and dealers are scrambling to survive. If you've been waiting for the right time to buy a new car, this might be your best chance in over a decade, but it won't last forever. In the next few minutes, I'm going to break down why this is happening, which brands are suffering the most, and how you can take advantage of these record-breaking discounts. Stick with me because the numbers I'm about to show you will change how you look at the car market in 2025. What's happening? Not long ago, dealerships were operating in one of the most profitable periods in history. The pandemic-induced supply shortages caused prices to skyrocket, and desperate buyers were willing to pay thousands over the manufacturer's suggested retail price just to secure a new vehicle. But now, the situation has flipped entirely. Across the country, dealership lots are overflowing with unsold cars, and the problem is only getting worse. The auto industry made a massive miscalculation. As supply chain issues eased, manufacturers ramped up production, expecting demand to remain high. They anticipated that people would continue to buy at inflated prices, just as they had in the previous few years. However, economic conditions changed rapidly. Inflation eroded disposable income, interest rates on car loans soared, and consumer confidence plummeted. Suddenly, people were no longer eager to spend tens of thousands of dollars on a new vehicle. This shift in demand left dealerships with a serious problem. They now have far more cars than they can sell. Manufacturers like Ford, General Motors, and Toyota are among the most affected, as they had banked on a sustained surge in sales. Large trucks and SUVs, once the most profitable segment, are now piling up on lots. Adding to the crisis, used car inventories are also swelling. Many people who financed vehicles at low interest rates in previous years are holding onto their cars longer, reducing the number of trade-ins. Meanwhile, rental car companies, which had previously been major buyers, are also cutting back their purchases. The result? An industry-wide inventory surplus that is rapidly turning into a financial nightmare. Dealerships are running out of space, automakers are pushing even more cars onto lots, and the entire system is teetering on the edge of collapse. While dealerships struggle to move their vehicles, consumers are making a bold statement by refusing to buy, at least not at these prices. The silent consumer rebellion. The issue is not just that dealerships have too many cars. The bigger problem is that consumers are no longer playing along. For years, car buyers had little leverage, forced to accept high prices due to low inventory. Now, however, the power dynamic has shifted and buyers are pushing back. One of the biggest deterrents is the skyrocketing cost of financing a car. Interest rates have risen to levels not seen in decades, making it significantly more expensive to take out an auto loan. A vehicle that may have seemed affordable just a few years ago now comes with a monthly payment that stretches many household budgets to the breaking point. Insurance costs have also surged. The average price of car insurance has nearly doubled in some areas, making the overall cost of vehicle ownership far higher than it used to be. Combined with rising fuel prices and maintenance expenses, many potential buyers are simply deciding that now is not the right time to purchase a new car. Another major factor is that consumers are waiting for even bigger discounts. Shoppers have seen reports of growing dealership inventories and are well aware that prices are likely to drop further. Instead of rushing to buy now, many are choosing to hold off, betting that dealerships will become even more desperate in the coming months. This new consumer mindset has sent shockwaves through the industry. Dealerships that were once able to sell vehicles within days of receiving them are now watching as cars sit on lots for weeks, then months, without attracting buyers. The longer a car sits unsold, the more costly it becomes for the dealership, leading to even greater financial pressure. This shift in consumer behavior has forced dealerships to confront a harsh reality. Their pricing power is gone, and they are no longer in control of the market. The collapse of the name your price era. For years, dealerships have operated in a market where they could dictate prices. Supply shortages meant that vehicles were in high demand, and customers had little choice but to accept whatever price was set. However, that era is now over, and dealerships are struggling to adjust. Some dealers have been slow to acknowledge the change. Many are still clinging to outdated pricing strategies, refusing to lower prices in hopes that demand will suddenly return. But this stubbornness is only making things worse. Cars that remain unsold for too long start accumulating carrying costs. Dealerships have to pay interest on their floor plan loans, cover insurance costs, and maintain the vehicles until they are sold. Other dealerships have recognized the shift and are starting to cut prices aggressively. Some models, particularly large trucks and SUVs, are already seeing deep discounts. Ford, for example, has been offering significant price cuts on its F-Series trucks, and General Motors has followed suit with incentives on the Chevrolet Silverado and GMC Sierra. 0% financing deals, once a rarity, are now making a comeback as well. In an attempt to attract buyers, many automakers are partnering with lenders to offer lower interest rates, making monthly payments more affordable. But even with these incentives, the market is not responding as quickly as dealerships had hoped. The damage done by years of inflated prices and high interest rates has left many buyers unwilling to jump back in just yet. Some are still waiting for better deals, while others have simply decided that they do not need a new car right now. With consumer resistance at an all-time high, dealerships are now experiencing a full-blown identity crisis. They are being forced to rethink their entire approach to sales, and many are struggling to adapt. With dealers finally realizing they cannot maintain the status quo, the next phase of this crisis will focus on how far they are willing to go to sell these vehicles. Massive discounts, record low financing, and special incentives are already in motion, but will it be enough to bring buyers back? Record-breaking discounts. Which cars are getting slashed? The auto industry is witnessing discounts that would have been unimaginable just a few years ago. With dealerships overwhelmed by unsold inventory, they are being forced to drop prices significantly, particularly on high-end trims and full-size trucks. Once highly sought-after vehicles are now sitting for months, prompting manufacturers to step in with massive incentives just to clear the lot. For years, trucks and SUVs were the backbone of dealership profits, with brands like Ford, Ram, and Toyota enjoying skyrocketing sales. However, those same models are now among the most heavily discounted. The Ford F-Series trucks, known for their reliability and dominance in the market, are now being offered with five-figure discounts, sometimes as much as $15,000 off. The Ford Bronco, which dealers once sold above sticker price, is now struggling to move, even with rebates up to $10,000. Luxury brands are also feeling the pressure. The Cadillac Escalade, which once had waiting lists, is now being advertised with discounts of $20,000 or more. The Jeep Grand Wagoneer, introduced as a premium SUV, is failing to attract buyers despite some models getting price cuts of over $25,000. Even sports cars like the Chevrolet Camaro and Ford Mustang are seeing price drops that would have been unthinkable just a few years ago. This dramatic shift highlights how quickly the market has turned. Buyers who once had to fight for inventory are now being courted with offers that are nearly unprecedented. But the real question is, are these discounts enough to convince people to buy? While new cars are seeing record discounts, this has also triggered a serious problem in the used car market, where values are sinking at an alarming rate. Used car values plummeting. The used car market is going through a collapse that mirrors the steep drop in new car prices. Over the last 12 months, trade-in values have fallen by 20% or more, meaning that vehicles that were once considered valuable assets are now worth thousands less. For many car owners, this means their current vehicles are depreciating faster than expected, making it difficult to trade up to a new model. The root of the issue is simple: supply and demand have reversed course. During the pandemic years, used cars were in high demand due to factory shutdowns and supply chain disruptions that made new vehicles scarce. Now, with dealerships flooded with new inventory, the need for used cars has evaporated. This shift has caused a surge in repossessions, as many car owners find themselves unable to keep up with high monthly payments on vehicles that are now worth much less than what they owe. Finance companies and banks are repossessing cars at a rate not seen since the last major economic downturn. Many of these repossessed vehicles are then sent to auction, adding even more supply to the used car market and further driving down prices. Some of the hardest hit vehicles include full-size trucks, luxury SUVs, and electric vehicles, as they have been the most overvalued in recent years. A used Ford F-150, which once held its value exceptionally well, has dropped significantly in resale price. Meanwhile, the Toyota Tacoma, a truck that was once considered nearly bulletproof in resale value, has seen trade-in values fall for the first time in years. For anyone considering trading in their vehicle, the timing could not be worse. Unless you absolutely need to upgrade, holding on to your current car might be the smartest financial move right now. If used cars are dropping in value this quickly, electric vehicles are experiencing an even more dramatic crash, one that is leaving early adopters in financial ruin. The EV market crash: why dealers can't get rid of electric cars. The electric vehicle market is in free fall, and the warning signs are everywhere. Despite automakers investing billions in electric car production, dealerships cannot move EVs off their lots. What was once seen as the future of the industry is now turning into an inventory nightmare. A major factor in this crash is that many EV owners are now underwater on their loans, meaning they owe significantly more than their vehicle is worth. This is particularly true for people who bought models like the Ford F-150 Lightning and Tesla Model Y at their peak pricing. Vehicles that once had dealer markups of $10,000 or more are now being sold with deep discounts, cash incentives, and 0% financing offers. Yet still, buyers remain hesitant. One reason for the lack of demand is the rapid pace of EV technology advancements. Many early adopters are watching their vehicles become outdated within a few years as newer, longer-range models hit the market. This has led to an accelerated depreciation rate, making used EVs almost impossible to sell at a reasonable price. Another factor is the lack of a strong nationwide charging infrastructure. Many consumers who were initially excited about the switch to electric are now realizing the limitations of owning an EV, especially in areas where charging stations are sparse or unreliable. With huge discounts failing to move inventory, some manufacturers may soon be forced to cut back EV production significantly. The push for electrification is proving to be much harder than automakers initially expected, and dealerships are now left holding the bag. With discounts failing to move inventory, automakers are turning to another desperate strategy: 0% financing. But is it really as good as it sounds? The 0% financing trap. Are these deals too good to be true? To combat falling demand, automakers are rolling out 0% financing deals at a rate not seen since the last financial crisis. These offers are designed to make car payments more attractive, luring in customers who may have been hesitant to buy. But are these deals really as beneficial as they seem? While they may appear enticing, there are several hidden factors that can make them less of a bargain than they initially appear. At first glance, 0% financing sounds like free money. Borrow the cost of a new vehicle and pay it back over several years without interest. However, there are often hidden drawbacks that consumers don't realize until they are locked into a loan. Automakers and dealerships structure these deals strategically, ensuring they still maximize profits despite the enticing offer. For starters, 0% financing deals usually require excellent credit. If your credit score isn't near perfect, you likely won't qualify for the offer. Instead, dealerships will push you into a higher interest loan, completely negating the advertised benefit. Many buyers walk into dealerships expecting to secure the deal, only to be offered a loan with an annual percentage rate exceeding 6 or 7%, making their payments significantly higher than anticipated. Additionally, these deals often replace cash rebates and direct price reductions. A dealership might offer 0% financing or a $10,000 discount, but not both. This means that in some cases, paying cash or financing with a standard interest rate might actually be a better deal overall. Savvy buyers should calculate the total cost of both options before making a decision, as a lower purchase price can sometimes outweigh the benefits of 0% interest. Another issue is that many of these loans are stretched over long terms, sometimes 72 or 84 months. While the monthly payment might seem affordable, buyers end up paying significantly more in the long run, especially when the vehicle begins to depreciate rapidly. By the time the loan is paid off, the car may be worth far less than what was initially borrowed, leaving buyers in a negative equity situation if they decide to trade in or sell early. The biggest risk, however, is that 0% financing locks buyers into an uncertain market. If prices continue to fall, anyone who buys today could end up paying far more than the car will be worth in just a year or two. Additionally, with the auto market in flux, unexpected industry shifts, such as production cuts, new incentives, or sudden depreciation trends, could make financing a vehicle today far riskier than in a more stable economy. With automakers running out of options, dealerships are left with one major question: what happens to all the unsold inventory? The answer could change the industry forever. What happens to cars that don't sell? Car dealerships are drowning in unsold inventory, and many are scrambling to find solutions before these vehicles become financial dead weight. Unlike everyday consumer products that can sit on store shelves indefinitely, new cars are depreciating assets, meaning the longer they remain unsold, the more money dealerships lose. So what actually happens to all these unsold vehicles? One of the first strategies dealerships use is shuffling inventory between locations. If a particular model isn't selling well in one area, area, dealerships will attempt to transfer it to another location where demand might be higher. This happens frequently in larger dealership networks where multiple locations exist within a region. However, with overstocking happening nationwide, this solution is proving less effective. Another option is auctioning off unsold vehicles. Wholesale auctions allow dealerships to offload cars at a lower price to used car dealerships or rental companies. But with used car values dropping rapidly, even auctions aren't offering the returns dealers once relied on. This means many are stuck choosing between selling at a loss or holding on to cars they simply can't move. In extreme cases, dealerships may return vehicles to automakers. Some manufacturers offer buyback programs when models sit unsold for too long. This often results in these cars being repurposed as fleet vehicles, sold at deep discounts to rental agencies, corporate fleets, or government agencies. While this helps clear inventory, it also lowers the overall value of that model, further hurting resale prices. Finally, some cars may face an even more drastic fate, being outright destroyed. This usually happens when a model is discontinued, recalled, or simply has no viable resale market. Automakers and dealerships would rather scrap cars than flood the market with massive markdowns that hurt their brand value. Now, the question remains, how are automakers responding to this crisis? With so many cars piling up on lots, manufacturers are being forced to make difficult decisions about production. Automakers under pressure. Will they cut production? For years, automakers ramped up production to meet post-pandemic demand, but now they are facing the consequences of overestimating consumer buying power. With dealerships struggling to move inventory, manufacturers like Toyota, Ford, and General Motors are finally being forced to slow down production, a move that could have major consequences across the entire auto industry. The industry-wide shift from supply shortages to inventory gluts is reshaping strategies, with automakers now prioritizing efficiency over volume to avoid further financial strain. Ford, for example, recently announced temporary factory shutdowns to prevent further overproduction. The company has already cut shifts at its F-Series truck plants, signaling that demand for high-priced trucks is waning. Meanwhile, General Motors has reduced production on certain Chevrolet and GMC models that are sitting unsold. Toyota, which historically avoided overproduction, is now being hit with unexpected slowdowns on key models like the Tacoma and Tundra, forcing them to rethink their supply chain strategy. Even electric vehicle manufacturers, once seen as immune to such issues, are facing similar challenges, with brands like Tesla and Rivian adjusting output to match shifting consumer preferences. Cutting production isn't just about slowing down assembly lines, it also impacts thousands of workers and suppliers. When automakers reduce output, they often implement temporary layoffs, leaving workers in a precarious position. Suppliers that provide parts for these vehicles also feel the strain, as lower production means fewer parts ordered, impacting industries beyond just car manufacturing. This can create financial instability for companies that rely heavily on contracts from major automakers, forcing them to adjust operations or lay off employees. The consequences extend even further into the broader economy. Many local economies rely on auto manufacturing plants for jobs, and sudden production halts can have ripple effects on surrounding businesses. Restaurants, retail stores, and other service industries in factory towns often see declines in revenue when plant workers face layoffs or reduced hours. A slowdown in vehicle production could also affect transportation, logistics, and even advertising industries as demand for marketing new vehicles diminishes. Additionally, if the slowdown persists, it could impact the stock market as major automakers and suppliers face declining revenues and investor confidence begins to waver. With production slowing down, buyers are wondering, when will we see the lowest prices? Let's explore when dealerships are likely to hit rock bottom and when buyers should act. When will prices bottom out? With dealerships slashing prices and automakers scaling back production, the biggest question for consumers is, when is the best time to buy? While it's impossible to predict the exact bottom of the market, several key indicators suggest that prices haven't hit their lowest point yet. Understanding these factors can help buyers time their purchases strategically to maximize savings. One of the biggest signals that prices will continue to drop is the sheer volume of unsold vehicles still sitting on dealership lots. Many dealers are offering large discounts now, but these price cuts haven't been enough to clear out inventory. As the months go by and dealerships become more desperate, even deeper discounts will likely appear. This is especially true for models that have seen weak demand, such as full-size trucks and certain SUVs, which are lingering on lots due to high fuel prices and shifting consumer preferences. The best time to buy a new vehicle will likely be between May and August, when dealerships historically experience slower sales due to summer vacations and consumer spending shifts. Additionally, manufacturers typically roll out new model year vehicles in the fall, meaning dealerships will need to clear out older inventory before newer models arrive. This combination of factors makes late summer an ideal window for bargain hunters, as dealers will be under pressure to move units before the next wave of models arrives. However, not all brands will lower prices at the same rate. Luxury brands and high-end trims may take longer to discount, since dealerships often have more room to wait out slow sales. On the other hand, brands like Jeep, Ford, and General Motors, who are currently sitting on the most unsold inventory, are likely to slash prices the fastest. Additionally, electric vehicle inventories have been building up, leading some manufacturers to introduce aggressive lease deals and incentives to move these models faster. Another factor to consider is loan interest rates, which remain high and are preventing many buyers from pulling the trigger. If interest rates remain elevated throughout 2025, we could see further price reductions as dealerships desperately try to offset high borrowing costs with deeper incentives. Buyers who can secure financing at a lower rate or purchase with cash will have a distinct advantage in negotiating even better deals. Additionally, if the Federal Reserve signals rate cuts later in the year, the resulting increase in demand could tighten inventories and reduce the likelihood of steep discounts. Even with discounts on the rise, the car buying experience is evolving, with prices fluctuating and dealerships struggling. Is this the beginning of the end for traditional car dealerships? The future of car buying. Are dealerships dying? The auto industry is undergoing a transformation unlike anything seen before, and the traditional dealership model is at the center of it. As online car sales and direct-to-consumer purchasing become more popular, the question arises, are dealerships on the path to extinction? Tesla has pioneered the direct-to-consumer model, selling vehicles without traditional dealerships and handling everything online. This has set a precedent that many automakers are now trying to follow. Ford has already hinted at scaling back dealership networks, while General Motors has launched pilot programs allowing customers to order vehicles online and have them delivered directly. For consumers, this shift means greater transparency and fewer markups. Online pricing eliminates the dealership's ability to inflate costs or add unnecessary fees, something that has historically frustrated buyers. Additionally, the growing popularity of subscription-based car ownership models suggests that consumers may move toward leasing or temporary ownership instead of long-term purchases. However, dealerships are fighting to stay relevant by offering incentives and expanding service-based revenue streams. Some are transforming into vehicle service hubs, focusing more on maintenance and repairs rather than direct sales. Others are experimenting with hybrid online and in-person sales models, where buyers can handle most of the purchase process online, but still visit the dealership for test drives or financing. Despite these efforts, it's clear that the dealership model is under immense pressure, as automakers experiment with cutting out the middleman, and consumers grow more comfortable with online car shopping. Traditional dealerships may find themselves reduced to smaller, service-focused operations rather than the dominant retail force they once were. So what does all this mean for the future? Prices are falling, production is slowing, and dealerships are struggling to adapt. The auto market is at a crossroads, and the next few months could determine how the industry reshapes itself moving forward. The car market is shifting fast, and dealerships are feeling the pressure like never before. Massive discounts, record inventory levels, and dropping demand are creating a situation we haven't seen in decades. But the big question is, how long will this last? Now, I want to hear from you. Are these discounts enough to get you to buy a new car right now, or are prices still too high? Do you think Ford, Toyota, and Jeep will recover, or is this just the beginning of a long-term decline? Let me know in the comments. And if you found this breakdown helpful, hit that like button and subscribe so you don't miss the next update on the wildest shifts happening in the car industry. Thanks for watching, and I'll see you in the next video.